Most traders don't lose because their strategy is bad. They lose because it's too complicated. You open your chart and add 3 indicators. They give you a signal, you take the trade, and you lose. So you remove one indicator and replace it with another. New setup, new signal, another loss. Then you change the entire strategy. Different indicators, different system, same result. Trade after trade, you keep searching for something new, when the real problem is complexity. Sometimes the best trade comes from just one candle. Look at a single candle on the 1-hour chart. It has a clear high and a clear low. That alone gives you a complete price range. Now drop to the 5-minute time frame and watch what happens inside that same candle. Price breaks out of the range, then closes right back inside it. That's not a breakout. That's manipulation. That's where the entry forms. That's where the stop loss goes. That's where the target sits. And then price moves exactly where it was supposed to go. At first, this looks extremely simple, but don't confuse simple with easy. It's just much cleaner than most of the overloaded strategies you've tried before.
Sell everything now.
One single candle can lead to high probability setups and precise entries. Moves that most traders only recognize after they're already over. Now consider the opposite situation. This time there's a bearish candle on the 1-hour chart. Again, it has a clear high and a clear low. That defines the full range. Drop to the 5-minute chart and watch what unfolds inside that candle. Price moves below the low. It looks like a breakout. Sellers enter expecting continuation, but then price closes back inside the range, forming a clear rejection. That's not weakness. That's manipulation. The market swept stops below the low before moving in the real direction. This is where the buy entry forms. The stop loss goes just below the sweep. The target sits near the opposite side of the range. And then price moves upward toward that target. It may look almost too simple, even stupid, but it works because the market typically moves in 3 phases. First, price moves sideways, accumulation. Then price breaks the range and traps traders' manipulation. Finally, the real move begins, distribution. Sideways, trap, real move. That's the market maker model. Now look at a live chart example. On the 1-hour chart, identify the anchor candle. It has a clear high and low. Once you mark those 2 levels, you have your range. Clean and simple. The next candle breaks below the low, but instead of continuing downward, it closes back inside the range. That's a major clue. On the higher time frame, it signals manipulation. Liquidity below the range has been swept. Drop to a lower time frame and look inside that same candle. Within that 1-hour move, you'll see the 3 phases clearly. First, sideways movement, accumulation. Smart money builds positions quietly. Then a spike below the range, stops are triggered and breakout traders jump in. That's manipulation. On the 1-hour chart, it just looks like a rejection candle. But on the lower time frame, you see the entire story hidden inside it. Once price closes back inside the range, manipulation is confirmed. That becomes your entry signal. The stop loss goes just beyond the sweep. The target sits near the opposite side of the range where liquidity is waiting. As price continues, it drives straight toward that target. No confusion, no indicators, just pure price behavior following the market maker model. One higher time frame candle becomes a complete roadmap. What you've seen so far is only a small portion of the full strategy. If you stop here, you'll end up with an incomplete setup. Incomplete strategies lead to impulsive decisions and unnecessary losses. So now let's look at the 2 core 1-candle setups that make this method work. The first setup is the foundation. It appears across all markets and time frames: Forex, crypto, indices, stocks. The logic is the same. Candle 1 is the anchor candle. It defines the range. Its high and low become your key levels. Everything that follows is traded around that range. Candle 2 is the manipulation candle. Price breaks above or below the anchor range, triggering stops and pulling breakout traders in. It often forms as a wick or rejection. Candle 3 is the expansion. After the liquidity sweep, price drives strongly in the opposite direction. That's the real move. But you don't chase the 3rd candle. You position yourself right after manipulation is confirmed. The second setup revolves around the inside bar. First, you get a strong candle. Then a smaller candle forms completely inside its range. That inside candle signals hesitation and hidden accumulation. Mark the high and low of the first candle. That's your range. Then price fakes a breakout. Liquidity is swept. Price snaps back inside the range. That snapback is your signal. The breakout is manipulation. The return inside is confirmation. The reversal is the trade. Now look at a real example on the British pound against the US dollar on the 15-minute chart. Identify a strong candle. That's your anchor. Mark its high and low. Those are your key reference points. The high acts as resistance, the low acts as support. Price breaks below support but closes back inside the range. That's a liquidity sweep. Breakout sellers get trapped. Liquidity is collected. Once that happens, price often moves toward the opposite side of the range. Drop to the 1-minute chart for execution. The same pattern appears again. Price breaks below the level, sweeps liquidity, then snaps back inside. That's another sell-side sweep. When the same signal appears on time frames, it strengthens the setup. The entry comes at the close of the 1-minute candle that returns inside the range. The stop loss goes just below the sweep. The target sits at the 15-minute high of the anchor candle. Now consider a situation that looks perfect but fails. On the 15-minute chart, you see an anchor candle and manipulation. Everything looks correct. You drop to the 1-minute chart, enter the trade, place stop and target. At first, price moves in your favor. Then it suddenly reverses and moves against you. You try another one. Same structure, same logic. Again, it fails. Why? The answer lies in higher time frame direction. Imagine two examples on the 15-minute chart. In the first, price breaks above the anchor high and closes back inside. In the second, price breaks below the anchor low and closes back inside. Which one has higher probability? The one aligned with the higher time frame direction. If the overall context is bearish and price sweeps above the range before closing back inside, that aligns with a bearish continuation. When you drop to the lower time frame, you're executing with the trend. But if the signal forms against the higher time frame direction, it's fighting momentum. It may look perfect structurally, but context reduces its probability. Look at a chart where the market is clearly trending upward. You identify an anchor candle, mark its high and low, an inside bar forms. Then price breaks below the low but closes back inside. That's a fakey setup in the direction of the trend. Because it aligns with the higher time frame movement, it becomes high probability. Drop to the 1-minute chart for execution. Enter at the close of the candle, returning inside the range. Stop below the sweep. Target at the high of the anchor candle. Price moves cleanly upward and reaches the target. Another rule: don't force trades. Patience is your real ed. G. If there's no clean liquidity sweep, skip the trade. Forced setups usually lead to losses. The best trades are obvious when they appear. Now consider another example on the British pound against the Japanese yen on the 15-minute chart. Identify the one-candle setup. Mark support and resistance to define the range. Wait. The next candle breaks above resistance but closes back inside. That's a clear buy-side liquidity sweep. Breakout buyers are trapped. Now price is likely to move in the opposite direction. Since one 15-minute candle contains 15 1-minute candles, drop down to refine the entry. On the 1-minute chart, price pushes above resistance again and closes back below it. That confirms the sweep. That candle becomes the entry trigger. Enter at the close of that 1-minute candle. Place the stop just above the high of the 15-minute candle. Set the target at the next support level from the 15-minute chart. Now let's move to another real chart example and continue applying the same logic step by step. Now let's look at another example. Solana against the US dollar. This time we're analyzing Solana on the 15-minute time frame. Before going further, remember this. The one-candle strategy works across all markets. Forex, crypto, stocks, indices, futures. The instrument may change, but liquidity behavior remains the same. First, identify the anchor candle. Mark its high as resistance and its low as support. That immediately defines your trading range. Once the range is clear, you wait for the liquidity sweep. Watch what happens next. The following candle breaks below support, but instead of continuing downward, it closes back inside the range. That's a clear sell-side liquidity sweep. The market has collected liquidity below the range, which increases the probability of a move upward. Now drop to the 1-minute chart to execute the trade. On the 1-minute time frame, price breaks below the same level again, then closes back inside the range. That confirms the sweep. This candle becomes your entry trigger. The entry is placed at the close of that 1-minute candle. The stop loss goes just below the sweep. The target sits at the next 15-minute level. Now watch what unfolds. Price moves cleanly toward the target exactly as anticipated. That's the one candle strategy in action. Simple, precise, based on real price behavior, not indicators, not guesswork. Now let's move to the final rule. This one often separates losing traders from consistently profitable ones. Always respect your risk to reward ratio. Look at two different setups. Both follow the rules, both show a clean liquidity sweep, both provide a valid entry. The question is, which one is better? The one on the left or the one on the right? The better trade is the one offering a higher reward relative to the risk. Even if both setups have identical probability of winning, the one with the stronger risk-to-reward ratio will generate more profit over time. This is where many traders make a critical mistake. They focus only on win rate, but win rate alone does not create profitability. Imagine winning only 4 trades out of 10. That's a 40% win rate. Most traders would consider that poor performance. But if each winning trade earns 3 times the amount you risk, and each losing trade costs only 1 unit of risk, you still end up profitable. Why? Because the size of your winners outweighs the number of your winners. Profitability is not about winning often. It's about managing risk and maximizing reward when you win. Instead of chasing a high win rate, focus on high-quality setups with strong risk-to-reward potential. That's how this strategy becomes sustainable over the long term. Now that you understand the structure of the one candle strategy, it's important to understand something even more powerful. This method is not about predicting the market. It's about reading behavior. Most traders try to predict what price will do next. They look for confirmation, indicators, signals that guarantee a move. But the market doesn't reward prediction. It rewards positioning. And positioning comes from understanding liquidity. Liquidity is the fuel of the market. Without liquidity, price cannot move. Every stop loss, every breakout entry, every pending order represents liquidity. Large participants don't randomly enter trades. They need liquidity to fill their positions. And where is liquidity usually resting? Above obvious highs? Below obvious lows? Around clean support and resistance levels? That's why the one candle strategy works. It doesn't rely on indicators. It relies on where traders are most likely trapped. When price breaks a range and immediately closes back inside, it tells a story. It shows that breakout traders entered too early. Their stops are now exposed. Their positions become fuel for the real move. That's the key idea. The fake breakout is not random noise. It's the mechanism the market uses to gather liquidity before expanding in the opposite direction. But here's where discipline becomes critical. Not every sweep will lead to a strong reversal. Context matters. Trend matters. Market conditions matter. If the higher time frame is strongly trending upward, sell-side sweeps often provide stronger buy setups. If the higher time frame is trending downward, buy-side sweeps often provide stronger sell setups. You must always ask yourself, am I trading with the higher time frame direction or against it? Trading against the higher time frame can work, but it usually has lower probability and smaller targets. Trading with the higher time frame direction aligns you with momentum, which increases the chance that price will continue toward your target. Another key factor is patience. The one candle setup is not something you force. Sometimes you will sit for hours and see nothing clean. That's normal. The market doesn't owe you a setup every session. If you start forcing trades just because you want action, you destroy the statistical edge of the strategy. Professional traders understand that inactivity is part of the job. Waiting is not weakness. Waiting is discipline. When a clean setup appears, it should be obvious. Clear anchor candle, clear range, clear liquidity sweep. Clear close back inside. If you have to convince yourself that it's valid, it probably isn't. Risk management must always stay consistent. No matter how good the setup looks, your risk per trade should remain fixed. Increasing risk because a setup looks perfect is emotional decision-making. The market doesn't reward emotional conviction. It rewards consistency. Over time, if you combine proper risk management with high-quality liquidity sweeps and strong risk-to-reward ratios, the numbers start working in your favor. You don't need a 70% win rate. You don't even need 60%. With strong risk to reward, even 40% to 50% can produce consistent profitability. Let's break it down simply. If you risk 1 unit per trade and aim for 3 units on winners, you only need to win 4 out of 10 trades to be profitable. That's the power of asymmetric reward. This is why focusing purely on win rate is misleading. A high win rate with small rewards often collapses during losing streaks. A balanced approach with strong reward relative to risk creates long-term stability. There will be losing trades. That's guaranteed. Some sweeps will fail. Some reversals will not follow through. Sometimes the market will sweep both sides before choosing direction. That's part of the game. What matters is that you follow the process exactly the same way every time. Consistency in execution leads to consistency in results. Another advanced concept to understand is session timing. Liquidity sweeps often occur during high-volume sessions when volatility increases. London Open, New York Open, major economic news releases. These are times when liquidity is more likely to be engineered. Being aware of timing improves your probability without adding complexity. But don't overload the strategy. The beauty of the one-candle concept is its simplicity. Anchor candle, range, sweep, confirmation, entry, stop, target, risk management. That's it. The moment you start adding 5 indicators and 10 confirmations, you move away from price behavior and back into complexity. Indicators lag. Liquidity doesn't. Your goal is to read the market as it is, not as an indicator interprets it. Backtest the strategy. Go through historical charts and mark anchor candles. Identify sweeps, track results, measure risk to reward. Build data. Confidence should come from data, not from excitement. When you see dozens of examples working over time, you'll stop doubting every trade. And when you stop doubting, execution becomes clean. One more important point: psychology. Even with a solid strategy, psychology can destroy performance. After 2 losses in a row, you may hesitate. After 2 wins, you may feel overconfident. Both reactions are dangerous. The market doesn't care about your last trade. Each setup is independent. Your job is simple. Execute the plan. When price sweeps and closes back inside the range in alignment with higher time frame direction, you execute. When it doesn't, you skip. When risk to reward is poor, you skip. When everything aligns, you take it without hesitation. That's professionalism. Over time, you'll notice something interesting. The market repeats behavior, not in identical patterns, but in structural behavior. Liquidity is taken, traps are formed, real moves follow, again and again, across assets, across time frames, across years. Once you train your eyes to see this behavior, you don't need clutter, you don't need complex systems, you need clarity. Clarity leads to precision, precision leads to confidence. Confidence built on data leads to consistency, and consistency leads to profitability. The one-candle strategy is not magic. It's not a secret shortcut. It's a framework for reading liquidity and positioning yourself where the real move begins, not where the trap is formed. Keep it simple. Respect risk. Wait for clean sweeps. Align with higher time frame direction. Focus on risk to reward. Execute consistently. That's how you turn a simple concept into a sustainable trading system. And that's how you move from guessing to understanding.